All right, welcome everyone to another Rocket Dollar webinar. This is your first one. We have some people who it's their first time or they've been on many webinars. Why do we do these? Rocket Dollar is a retirement-focused company, but we do this to educate our customers on all the different asset classes out there. Some people might have gotten started with us in startups, real estate, or crypto, but sometimes they're a little intimidated on how to get into an asset they're not as familiar in, or they're hunting for deal flow in an asset they already know very well. So I got started talking to the Arrive team in the fall at a conference, and a couple of things really caught our eye and ear about it. One, they have an investment minimum that allows a lot of people to participate in this. So we get a lot of people accredited and sometimes they're not accredited investors are really frustrated, and high minimum of $50,000 to get into some deals. The Arrive team has stuff that's much more accessible. UBIT, I'm not going to go the whole complexities in there, but the Arrive team is something that's basically UBIT free for real estate, which is a huge relief for a lot of our customers. So I got started with Jake. He doesn't have his camera on today, but Jake and the Arrive team, and we said, hey, let's really get this partnership going. Let's talk about a webinar. So we have Ryan Frazier, the CEO and founder of Arrived, and also Cameron Wu, the VP of Investments. Guys, why don't you introduce yourselves today?
Great, yeah, and thanks, Brendan, for the introduction. And yeah, I'm Ryan, the co-founder and CEO of Arrived, and ownership of homes and single-family rentals has been a passion of mine for over a decade at this point, and excited to talk just a bit about the market and how we think about things, but also how Arrived works. And Cameron, yeah, I'll let you introduce yourself.
Yeah, thanks. So name's Cameron, come from an entrepreneurial real estate family. So I've been involved in real estate in most of my life in a lot of different aspects. I've started a hard money lending business in Las Vegas, and also worked for American Homes for Rent for 7 years, leading their pricing, analytics, and asset management functions. Excited to be working with Arrive today, a great mission, and hope you all can participate with us.
Yeah, and we're gonna have some slides from Cameron and Ryan here. If you have questions, you can feel free to answer them. I will probably have most of the questions be answered at the end. If something's really burning, I think it's a really good topic to bring up, I'll interrupt Cameron and Ryan to make sure that we cover it. Otherwise, we'll cover that at the end. So we're gonna hear from both of them, just kind of about Arrive, how Arrive works. And then also at the end of today, we have a little YouTube video that Jake and I did, just how to get a Rocket Dollar investment from your retirement account into Arrived, with a nice update they just did to their website. All right, take it away, Ryan.
Awesome. Yeah, and if you pass the screen share for the host, I'll pull up the slides.
There you go.
Perfect. Thank you. And thanks, everyone. Just give me 1 second while I pull up our content, and we're getting that added now. One more moment. There we go. Okay. So as we just a kind of brief primer to Arrive before we get started. Arrive is a platform for investing in shares of individual rental homes. So investors on Arrive get to pick and choose individual single-family homes that are operated as a rental that they want to invest in. They can invest anywhere from $100 to over $25,000 per house, essentially up to about 10% of the shares, and build a portfolio, invest in individual homes across the country. Today we're in 15 markets, and excited to share more about Arrive. But before we really talk about Arrive, maybe we can jump into the agenda a little bit, because we're going to really start with some information around why real estate, and why has real estate been such an important part of people's portfolios in the past, and how do we think about investing in real estate in general. Some of the different ways to get started in investing in real estate. And then I'll do a brief introduction to Arrived. And then Cameron will take over and talk a bit about how Arrived works, some of the benefits of our operating model in terms of how we're buying homes and operating them for clients, and then how to get started for anyone who's interested in investing with us. And then we'll tee up live Q&A here at the end. So feel free to leave comments in the chat or the Q&A box through Zoom, and we'll get to all of those here at the end of the call. And so with that, we'll kind of start with, what are the benefits of investing in real estate, and really just thinking about this category overall. And I think one of the big things that really brings a lot of people to real estate is just the consistency with how it has generated returns. And with real estate, if you think about the way that you make money in terms of kind of cash in your pocket, there's really two main ways. One is, that consistent property value growth. So as these property values grow over time, your equity position can grow proportionally. And then you're also operating them as a rental. So you're getting this great rental income that's coming in and getting paid out on a consistent basis. Over the last 20 years, we've done a longitudinal study of single family rentals. And what we found is, across the country, on average, the historical equity appreciation has been about 6.1% per year. And the average dividend yields that an investor could have expected to be paid out based on how Arrive's operating model is about 5.6% on an annualized basis. And so that gets us to about 11.7%. It's kind of the expected historical rate of return over the last 20 years that that rental properties have really driven. And when you think about, how do those returns compare to other assets like the stock market, really real estate has, and specifically rental properties, outperformed the S&P 500 over the last 20 years. And it's really driven by that consistency in terms of, its ability to both combine, property value growth in a kind of asset type where there's continual demand from lots of different buyers, and it's really hard to develop new supply quickly. And then you have that consistency of income and the compounding factor of those dividends. And so on a combined basis, over the last 20 years, we see rental properties delivering about 11.7% average annual rate of return compared to 9.4% for the S&P 500. And the next reason that people really look to real estate is for diversification. And this just goes back to modern portfolio theory, and that the idea that a well-diversified portfolio can deliver the same rate of return or a higher rate of return for lower associated risk. And that's really the benefit that diversification can provide, is getting you to those rate of returns that you're targeting, but with spreading that risk around. And real estate has been, particularly interesting way to diversify overall portfolios, because it has just historically had a much lower correlation to the stock market where, a lot of people traditionally invested. And that's even more so true for, private real estate. And so for that reason, you often find that there's recommendations from financial advisors around, some percentage of your portfolio being allocated to real estate. And then the last piece is the impact of leverage, and the fact that real estate, because of its, the broad demand, the fact that it's a very clear asset backed and can be a liquid asset in the market, there's a lot of potential buyers, have had these low rates of debt. And that gives the opportunity to investors in real estate to access positive leverage, where the interest rates that you're paying for the debt that you're adding to real estate is lower than the yield or cap rates that you're getting, and also the annual rates of return. And those factors, used modestly, can provide that positive leverage that are really an important part of, the return profile for folks investing in real estate. And so with that in mind, how does one get started? Where do you invest in real estate, and what types of real estate assets might you consider investing in? And there's several different types of real estate that I'm sure most of you are familiar with. One is commercial. So these are things like retail and office buildings, things that you find around your community. Industrial, like warehouses or factories, maybe you could consider self-storage here. And then residential, like single family homes or multi-family buildings. and then vacant land. And then in terms of how you might invest in real estate, you can buy property directly, where you go through the full process of buying the home and lining up the mortgage and searching the market and ultimately managing those properties. Or you can invest in REITs, or real estate investment trusts. And most of the time when people think about REITs, they think of public REITs that you buy through your stock brokerage account. And then when you think about the different platforms to invest, there are new real estate platforms that are emerging to allow you to invest in private real estate online. And some of those companies like Fundrise or Realty Mogul give you access to commercial properties that we talked about. Companies like Ground Floor that may give access to investing in debt alongside real estate, so kind of acting as the bank. And then Arrive sits here as well, where we're a platform that makes it easy to invest in equity positions in single family rental homes, and really working hard to make that process very simple to build a portfolio of single family rentals and access that market. Functionally, we can talk about tax a little bit later, and happy to jump into that more in the Q&A, but also technically each home that clients invest in on Arrived are taxed as a REIT as well. But it's a private, accessing private direct real estate investment. And when we think about, why single family, I think that one, it's an asset type that, people really relate with, and that there's a lot of demand for investing in rental properties. And I think the reason is that as we looked at the returns and the lower correlation to the stock market, there's a lot of demand for diversifying into, rental properties. At the same time, on a, macro perspective, housing prices continue to go up. There's a ton of buyer demand from, people who are looking to move into homes, other investors that are looking to acquire whole homes, institutional investors and single family. And really the developer and builder marketplace has not been able to keep up with the demand for housing. And so the market has been way under supply. At the same time, the cost of raw materials and labor has continued to go up. So it's getting more expensive to create more supply. And those are putting pressure on, housing prices continue to go up. On the other side, the rental, income side of single family homes is that, as just a society in this country, we're on average renting for longer in our lives. We're renting at later stages in our lives when we have slightly larger families. And so there's an interest and need in renting quality single family homes. And so that means that the renter community is really driving a ton of demand for quality turnkey rental properties as well. And so that's the other side of this on why you've seen these build for rent communities start to populate to try to keep up with this renter demand that's really looking for additional housing types as they're looking for that flexibility. But while we see the economic side of single family homes as very compelling, the process to buy and invest in this market has just been way too complex. It often takes months of work between finding, buying, and then operating that home. And then there's personal liability involved where you are personally liable for the debt that you're taking out, for tenant relationships, or for managing the property management, and then any kind of unplanned out-of-pocket expenses. And really what we're trying to do with Arrive is just dramatically simplify that process to more of a modern investing experience that I think we're all really used to in other asset classes. And so with Arrive, it's very simple. You browse homes that we have available across the country. You can see information on those homes, just like you might on Zillow or other property listing sites, get all of the information there. And then you can buy shares directly from the page. It takes just a few minutes to go through the process of buying shares. You can decide how much you want to invest in each home, and you can build a portfolio that way. And then it truly is turnkey. You start earning income and accessing property value growth right away from that point on. And Arrive takes care of everything behind the scenes. So it really is kind of, you have that peace of mind. It's a passive investment going forward. There's no unplanned or unexpected out-of-pocket expenses, that's all covered by the property operations and our management of the property. And so that's a little bit about Arrived, and also how we think about real estate as a market. And with that, I'll hand it over to Cameron to just go into a little bit more about how Arrived works, what some of the benefits are for people who might be interested in investing with us, and then how to get started.
Thanks, Ryan. So I'll take you through the process of how we actually acquire homes, and then the process of turning it into a fractionalized investment. And once we go through all of that, we'll discuss some of the benefits of investing with Arrived. And from there, kind of bring it home with how you can get started. So from a top-down approach, we look at which markets and neighborhoods are best suitable for our model. We look at things like population growth and job growth as fundamental economic drivers of where price appreciation will happen. On the supply side of things, Ryan alluded to some of the tailwinds for home prices experiencing strong appreciation. And we also like to invest in markets where there are challenges to adding more supply to the market, because naturally the existing inventory will start to increase in prices. But even with that said, we are a company that is building a national footprint. We're going to all of the tier 1 markets and also expanding to a lot of the tier 2 and 3 markets, because it's one thing to look at in the rearview mirror, how have certain markets appreciated and where have the winners been? You look at, say, California for the last 40, 50 years, and it's experienced incredible price appreciation. But is that going to be the case going forward? So we like to look at forward-looking indicators, namely that population and economic growth, to determine where are the future winners going to be. Human populations tend to consolidate, right? So there's going to be aggregate demand in various MSAs. So we're very strategically looking at that data to try to figure out, where do our investors want to be in 5 to 7 years? Buy today and say, well, I'm glad I bought in those areas 5 years ago. So next bullet point, buy the right homes. There are, we're operating them as rental properties, and not all properties are created equally in terms of having the right economic profile to be suitable for a rental. An example of that would be buying a $2 million home. Pretty nice, but doesn't exactly get you the required rental return as an investor. So we try to find the best properties that'll give you the best dividend returns for the holding period, as well as be in those neighborhoods that are highly desirable, where infrastructure is coming in, where the path of progress is coming, so that by the time we do liquidate the investment and sell it on the open market, you'll have captured the most rental income during the holding period, and then be able to capture a lot of the appreciation when we do sell it. Once we acquire those homes, we improve those homes. There are a lot of smart adjustments we can make on making the home suitable for a rental that seems to be really great for rental returns. An example of that would be, let's say that there's a lot of carpet in a home, and once that carpet reaches the end of its useful life, we would opt to not replace it with additional carpet, which would continue to need to be replaced very frequently, but we'd replace it with luxury vinyl plank, LVP, very durable material. Carpet typically has a life of anywhere from 3 to 7 years. And LVP is rated for 15 years. So it's good for high traffic areas. It's good for being kind of resistant against any sort of moisture, water damage, things like that. It doesn't retain smells. So it's not even that much more expensive than carpet, maybe a little bit more, but you get it back in rent, you get it back in maintaining your expense profile and keeping that under control. Next, we rent with longer term leases. So I spent 7 years in the institutional single family residential business. And one of the biggest things that really turned renters off about the model is that we would ask for increases every 12 months. So you feel like you're in the same home and your home's not really changing. So you're like, what am I paying more for? So we opt to find tenants in the range who are willing to commit for at least 24 months. And what we find is that really biases towards a tenant who's committed to the market. And in exchange, we give them market rent and lock that in for 2 years. So there's a good measure of stability on our rent roll, and the tenants feel like they're getting value by not being subject to rental increases every 12 months. So that improves our occupancy, reduces vacancy, reduces turn expenses. So all in all, we believe it is the winning strategy for optimal cash flow. And then finally, we offer to investors. So kind of behind the scenes, how do we fractionalize this? The way it works is that we place every property into a series LLC, and then we qualify that with the SEC so that it is a registered qualified security. And what you're really buying is a portion of that LLC that owns that property underneath. So that's a good transition into the next slide, benefits of investing with Rive. So keep that structure in mind that what you're buying is a piece of a company that owns that property. So first, passive income. So as Ryan mentioned earlier, we take care of all of the logistics. We take care of acquiring the homes, getting it ready, finding the tenants, orchestrating property management, and really managing the life cycle of that investment. So we pay dividends on a quarterly basis. And then at the end of the year, we send you a statement of your returns. But also on our website, we're constantly building out new features so you can have really clear visibility into how your portfolio is performing. Next, capital appreciation. So you get the full economic pass-through as an owner of the company. And that includes both rental income and the capital appreciation upon the sale. So once we net out all of the transaction costs, which are typically around 6% in today's markets, then you receive that proportional share of that capital appreciation. Next is no liability debt. We structure all of our investments to carry a very moderate amount of debt that helps magnify the returns. So we're getting pretty competitive rates right now. And the best thing about it is the no liability part. So it is a non-recourse mortgage, meaning that if the debt ever did go into a status of default, the investors are not liable for the repayment, which is very different than if you were typically going to get mortgage as a retail investor or entrepreneur. You are typically guaranteeing or backing that promissory note, and your lender could come after you to repay all of the debt if it is underwater. So on top of that, we also don't require that the investors qualify for any sort of credit. So whether you have excellent credit to no credit, it is not any sort of requirement on our end to be able to pass you on the benefits of that leverage. Next, no operational responsibility, very similar to the idea of passive income, but there's a great phrase where we're helping people avoid the 3 T's: the toilets, the trashes, and the taxes. Now, by virtue of being an IRA investor, you are already avoiding the taxes, so great there, but you're also avoiding the toilets and the trash with Arrived helping take care of all of the investment. So you receive your dividends on that quarterly schedule like clockwork, and we try to make it as easy as possible while replicating all of the great benefits of direct ownership of real estate. Tax advantages. So typically this is where I'll go into talking about depreciation and long-term capital gains, but the Rocket Dollar crew is already doing one better than that by having their money invested in self-directed IRAs. So as you all know, there are no tax liabilities for any of the gains being held in this form. But just so everybody's on the same page, if you were to venture into real estate outside of an IRA context, you do get the depreciation. So you get tax deferred cash flow because the depreciation is netting against those gross rental receipts. And you would only be paying a portion of your tax of the cash flow as taxable income. And then as the depreciation nets against the book value of the property, when you do sell it, you recapture that at favorable long-term capital gains rates, which are typically lower than the ordinary income rates that you would pay on wages and things like that. Next, low minimum investment. So the starting investment amount is $100 per property. And we see that most of our investors are investing around $3,000 in their portfolio with the offerings that we've had so far. And our client feedback is that they love the ability to diversify across multiple properties for whatever amount of cash that they were wanting to allocate towards their real estate portfolio. So, it really ties into the next 2 points about diversification and flexibility. Not all properties have the same economic profile. Some properties are located in markets that have higher appreciation potential, but that price already reflects an assumed amount of growth in there. So the dividend yields are lower in those markets. So you may think of some coastal markets that are more expensive properties, but you can also invest in markets that have higher income returns. So one of the markets that we're in, Columbia, South Carolina, it is a really great cash generating mechanism. So we get really high cap rates, which is basically your operating income divided by the amount of money that you have invested in it. So with our low minimums, you can allocate your money towards some high appreciation markets where you're not getting as strong of a rental income, but you're wagering that there's going to be higher capital gains on the back end. And then you can also mix in with strong income producers, so you can make sure that you're getting income today without taking the chance, quite as much of a chance on the thesis of appreciation. And flexibility. So, as we said, you can invest all over the country with Arrive $100 at a time. And people that are in the business of real estate or who are comfortable with it, I think it's great that you can do your own transactions. We certainly encourage it. But one of the difficult parts about investing in real estate is that it can be pretty operationally intensive. So going outside of your own backyard is one of the benefits that we've heard that clients who are really well seasoned in real estate, they love the aspect that they can have a professionally managed investment with the same sort of economics and return profiles as their own direct real estate investing, but now have access to all over the country. So 10 months ago, we were in Northwest Arkansas in Fayetteville, Bentonville area. Today, we are in nearly 15 markets. So we're expanding quickly and we're picking the best assets within each of those markets to be able to deliver to our investors. So really great aspects of diversification and flexibility through the Arrive platform. So how do we get started? The website has a really clean interface, very simple. From the time that you make an account to the time that you're signing documents, owning your first or your 10th real estate investment, it only takes about 5 minutes. So you can scroll through the investments, understand the profile in terms of how much does it cost, what's the monthly rent, what % financing do we have on it. You can scroll through pictures. And when you register, there's a couple pieces of information that we do collect that, we just want everybody to be cognizant of, very similar to any sort of investment that you would typically make, but we do require some KYC information. So you'll be entering in your case, as an IRA investor, possibly the EIN of your entity. So that way we can help prepare statements at the end of the year, as well as connecting that account. We use Plaid. So we never store any of the financial information on our servers. We just pass it through to a provider. But to the extent that you need assistance with making a connection, we can also help you with that. And from there, once you do own your properties, then it becomes that passive experience where we're sending you quarterly distributions and updating your portfolio page with how your investments are doing. So with that, that's the end of our prepared remarks. So want to thank you for attending and ready to take some questions and answers. So thank you very much.
Thanks so much. And before we get into the questions, I'll remind everyone, after we upload this recording, which we're going to need to pass around because we have well over 150 people registered for this. So you all need to tell your friends that didn't come today to watch the YouTube, but that we will have instructions on how to sign up on the Arrive website, going step by step. So if you're following through with your own IRA LLC, you'll be able to get your IRA signed up, connect your bank account, and move money to the platform. All right, so thank you for waiting on the questions here. We have a couple. All right. Thomas asked, so this is he asked a tax question about tax forms, but I wanted to bring it up because Jake and I just talked about this yesterday. So Cameron and Ryan, let's talk first about a taxable investor, and then we'll pivot to a retirement investor. Thomas asked, what forms do we receive at tax time? A K-1, a 1099? Do we receive a tax form for each individual property?
Great. So I'll start with someone who's signing up with a taxable account, and then Cameron, I'll let you chime in with an IRA account. But basically, investors who sign up with a taxable account are going to get a 1099 div by the end of January following each tax year. It's going to be a consolidated Form 1099 div just like you might have expected from any other brokerage account that you might use to invest in stocks, for example. And then the other question of, do you get a K1? Do you get it per property? The reason why it's a 1099 div is because each house is structured as a REIT instead of a partnership, which would distribute a K1. And that's really important to be able to, we want to make it very easy come tax time to have, the simplicity of a 1099 div, also so that it only has to be filed in the state where you file your primary tax returns. If you were to invest, in 15 houses in 15 markets that was taxed as a partnership, you'd have to file a state return in each area where you had a property. And so with this setup, with the REIT and 1099 div, you only have to file in your home state.
Okay, great. And then Cameron, so, we were talking with the onboarding, you guys have basically disabled 1099 reporting going to the IRS. So just so everyone knows what that means is, it's okay if, Arrive gives you a 1099 as like informational only. If you're a retirement investor, it's okay that one is generated or to look at it. However, the provider not actually sending it to the IRS, that's the important part for an IRA. You don't want that confusion to get started.
Yes, and I believe that the obligation is to report the fair market value of the assets at the time. So on our portfolio page, you will have visibility into that. We are releasing our, we are very close to releasing our product that gives you more visibility into your portfolio value with updated quarterly assessments of those property values, as well as you'll have access to your historical dividends as well. So there's always going to be full transparency for the cash distributions you're receiving on a per property and portfolio basis, as well as a quarterly update on the fair market value of your assets.
Okay. And is that individualized for each property, Cameron and Ryan?
Yes.
Okay.
That information exists both at the individual investment and then would roll up to your portfolio.
Great. All right.
And the last thing I'll just say is when you're creating an account, you just will select, retirement account and checkbook IRA or your IRA record. And that's what will establish the account as an IRA so that we aren't reporting those 1099s.
Yeah, so commonly known as an IRA LLC, some people call it checkbook IRAs, bank control. We're trying to popularize the term bring your own deal, just so people kind of understand what that means. Arrive has added that to their onboarding, so you can basically click and follow that instructions. All right, thank you, Thomas, for the question. All right, so, Michael had a question. I think this is sometimes on alternatives people's minds, and we have some audiences that get very hardcore into alternatives, or they're already into alternatives that are getting more heavily into it. So I'll try and answer it a little bit, Michael, and then we can get Ryan and Cameron to chime in. I've always wondered, since real estate has consistent returns that's more stable than the stock market, the percentage of investment in real estate, should that be, the largest portion of our diversification? And I would say, just from the Rocket Dollar audience, knowing that, make sure that if you are constructing a portfolio of more alternatives, that you just keep in mind of the risk levels of what you're dealing with. So like we have investors that are very heavy into crypto, or real estate or startups. You make sure that, if you have your high risk stocks, your medium risk stocks, and your low risk stocks, and maybe some bonds that are ultra safe, you kind of think of a similar construction in the alternative assets that you make in your portfolio compared to your age, what you're willing to stomach. So anything to add there on that? Because we get some real big, big real estate fans. They keep putting more and more money into real estate.
Yeah.
Yeah. The thing that I would add is that real estate tends to best perform on a long-term horizon. And as an IRA investor, I think that you would typically have that longer-term horizon compared to the other extreme end. Let's call it the Reddit meme stock, day trading group. Right. So with real estate investments, we certainly encourage you to stay in it for the entire investment thesis, as you'll be able to capture the most appreciation and have that longer period of time to amortize fees over. So, as far as what percent of your portfolio should you have allocated to real estate, I just think it's different for everybody as far as your risk tolerances go. But the great thing about single family residential is that it combines both a strong appreciation thesis with pretty stable and competitive returns, very close to, call it investment grade fixed income, right? So you kind of get that best best of both worlds in that profile.
All right. Thank you, Cameron. Yeah, and you know, the Rocket Dollar customer, sometimes it's a little bit of adjustment. You know, they'll have stocks in their brokerage accounts, you know, that they might be taking out for life events or buying a, you know, a livable house of their own, or like something like a wedding, having kids. You know, and they do think of, okay, I have some more of my stocks in my retirement account long term. Sometimes they need to go through the same mental process to get, hey, this is a long-term investment, even if it sells in a few years. You know, usually that's money's not really accessible unless it's a Roth IRA. In a traditional IRA, you should be having that until 59 and a half or longer. All right, thank you. That leads into Michael's question. He had, is there a lockup period on any investments? What happens when Arrive may sell a home in 3 to 5 years from the initial investment? Would I need to sell my investment earlier? What if I need to sell my investment earlier than when Arrive closes on the property and sells the property?
Great. Yeah, I think great question. And the short answer is that there are ways to get liquidity earlier than the full investment period. But to start, I'll kind of reiterate Cameron and say that, you know, our view and what we recommend is to be thinking about real estate over the long term. And that's really what has performed best historically. And so when we're buying properties and offering the investments, we're doing so with at least a 5 to 7 year investment period or thesis in mind for those homes. But we also know that, you know, clients may want to get liquidity in individual investments or their portfolio earlier than that. And so right now we're basically finishing a redemption program that we expect will be ready in the summer by the end of Q2. And basically, as part of that, we'll update the current net asset value for shares and homes that you're invested in and allow you to basically redeem those shares based on that price point. And that's something that would allow you to get liquidity earlier in the process. And we're just working through qualifying that with the SEC right now. So that's coming over the next 6 months or so. And then a little bit longer term than that, we're also building a secondary marketplace where clients on Arrive could actually buy and sell portfolios from each other. And that long down the road will be another form of potentially getting liquidity that we see in the marketplace. And yeah, really just want to make sure that there are those options available, but also encourage that, you know, we really see this as long-term investing.
Okay. And Eddie asked a question. This was really early in the webinar, but I think he was asking, are the invested funds a percentage of an entire portfolio or percentage of a specific asset? So I think what Eddie was getting at, he was asking like, hey, when you go to Arrive, are you investing in some type of fund or you're investing in actually specific assets? So with Arrive, you can go into specific properties. You can choose how much you want to allocate.
Correct. Yep. You browse individual properties and you choose your allocation per property today.
Okay. We've been getting a few questions about inventory. So there's one from, let me go back. There's one from David asking about inventory, and there's one from Jason asking, are all the properties listed on your site already closed on, or how long do you forecast? And just so you know, I was, you know, coming to the Arrive website as a new user. Make sure you click around on the for sale and the trending, and then the sold out ones, so that you can see the different filters that Arrive is using. Because I had a misconception. I said, oh, there's a lot more popping up here. So any commentary on inventory on your guys' website and how you guys planning that in this really competitive market?
Yeah, so all of the inventory that we have on our website is acquired. Some of them are leased, some of them are in the process of getting renovated and leased. And as far as from the time that we acquire it to getting a paying tenant in there, that process can vary a lot in terms of seasonality. We aim for about 45 days from acquisition. In spring and summer months, when it's pretty hot, we are able to lease properties, 5, 6, 7 days, get them ready in 10 to 14. In the fall and winter months, we find that there is a very seasonal component to rentals. So sometimes properties may take 2 months, 3 months. We account for a lot of this in our underwriting though. So to the extent that we, as an investment provider, kind of abstract away some of that volatility and seasonality in the cash flow, we include that as part of our model and look to stabilize the dividends that our investors receive.
Great. Okay.
And I'll also just add,
go ahead.
oh, go ahead.
I was going to do another question, so feel free to add on, Ryan.
Yeah, just the second part of that question on, the inventory availability. I think we have 9 or 10 properties that we've just added that are being funded right now by clients that if you click on trending or for sale, you'll see. And so they're available there now. I think across 5 or 6 markets or so. And then we release properties in batches about twice per month or so. So you see new inventory coming online on an ongoing basis as well.
Okay. And all right, so someone was asking about dividends, I think both Jeff and Teresa. So we talked about the exit already a little bit. Is there a minimum investment? It's $100. Right? And
Yeah.
Go ahead, Ryan.
Yeah, the minimum investment is $100 per house. And then the maximum investment per house is about 10% of the shares of the house. And that's really because of the real estate investment trust or REIT tax structure that 10% cap is there. And then, but there's no caps in terms of how much you invest across Arrive broadly.
Okay.
Mhm.
And are quarterly distributions fixed or guaranteed, or they kind of move around and are flexible?
Yeah, dividends are paid quarterly today. Right now, properties are paying out, I think about 5 to 7% on an annualized basis is what we've seen. They're based on the underlying property performance, but they tend to be, very consistent at the individual property level. What we do is have a cash reserve that we hold for vacancy, maintenance, tax and mortgage payments, things like that, which allow that cash reserve to be the kind of buffer so that you have the more consistent payments on the dividends. And that way, things like, annual tax payments or a one-time maintenance expense don't really impact the quarterly or recurring dividends. The cash reserve will kind of help support, and then there's an allocation from future rental income that keeps it filled up, and that's what drives the consistency.
Okay. All right, great. Thank you, Ryan.
Mhm.
What triggers a sale of a property for capital appreciation?
Yeah, so there's not a hard and fast rule that says when it reaches this amount, we will sell. So, because that can occur at a lot of different points depending on the market. One way to answer this question is thinking about the inverse. When would we not sell? Just to give people an idea of kind of the investment philosophy. So it's conceivable that there may be a downturn in the markets by the time that 5 to 7 year horizon has arrived. So the last thing we would ever do is disadvantage our investors by selling for a loss or for no gain. There's just simply no reason to, especially when it is a cash producing asset. So we would continue to operate it as a rental. And then when the markets do return and there is material appreciation to be had, then at that point we would consider selling the investment. So again, no hard and fast rule, but the idea is to never allow our investors to take a loss on the capital side.
All right, thank you. Has Arrive Homes have been through the 5 to 7 year cycle already? So I guess this is just a little bit, bigger question is kind of like, how long has Arrive been around, and how long have you been testing your thesis and things like that?
Yeah, so Arrive's been around since 2019, and we spent a year first, building the product and working with the U.S. Securities and Exchange Commission, the SEC, on creating the offering so that we could let people invest in shares of homes. And so we launched the portfolio in April of last year and have really been growing very quickly in that time. We've also had some great backing for the business, raising venture capital that's backed by Bezos Expeditions, the investment arm of Jeff Bezos, and Mark Benioff through Time Ventures, and Spencer Raskoff, the former founder and CEO of Zillow. And so we've got a ton of support from folks behind the business. At the same time, we just have announced a new $100 million credit facility that we've been using to increase our acquisitions of homes, and really relying on the rich experience that we have on the management team, like Cameron's experience with 7 years at American Homes for Rent, really scaling up their real estate portfolio. And so, no, we haven't had any properties that have gone through the full 5 to 7 year cycle, but very excited about bringing this product to market and getting folks access to investing in homes.
Great, thank you. Michael's really wanted to ask this one. Do employees of
Yeah.
Arrived have investments in actual homes that you list on your platform?
Yeah, so we have a bonus program where everyone at Arrive, also the entire team, gets a bonus that on an ongoing basis, paid out per month, that they are invest in homes. Not required to do so, but the vast majority of the team has investments in all of the homes. I'm personally invested in, I think, at least 90% of the homes on the platform as well. I would be 100%, but sometimes they fund faster than I'm able to get in and get shares. My goal was to have shares in all of the homes, but then some of them started funding before I could get in, and so I haven't been able to do it. But we love the question. Like we want to be very aligned with our clients. That's why we created the program for our team, so that everyone would have resources as part of their ongoing bonus program to be able to invest in homes. And we want them to have access to passive income too. And so, yeah, that's really important for us, and also aligning the incentives of our team with our clients.
Great, thank you. Yeah, we found like, some of the best things that have helped our team is, just giving our team Rocket Dollar accounts. You actually using the platform yourself, like we learned so much about that, and some little things in a totally separate part of the Rocket Dollar team we don't really understand. You learn that suddenly when you get down deep in the product. So thank you, Michael. Very honorable. You did not reserve a little space for yourself in each of these homes. Got too busy.
Yeah.
All right. So if there's anyone in the chat that has not gotten it answered yet, you can throw it in the Q&A. I'm about to answer Micah's in there. But if we've missed you, please throw it in Q&A because it's easier to track over there. So Micah asked, what is the difference between an owner and a new property on the platform? Is owner homes already owned by Arrived and looking to lease? And new property, our homes Arrived is looking to purchase. So I believe you said everything everything someone sees is already acquired, correct?
Mm-hmm. Yeah, all of the homes on the platform are already owned by Arrive today. And the owner flag on properties really just indicates which homes you've already invested in and own shares of. So that'll only be seen once you invest in a property, and it indicates you already own shares in this home. The new property is new properties that we've just started selling shares in. That's what that flag is for. And then you'll also see trending. And basically, those are the homes that are just closest to fully funding. And those are the flags there.
Okay. All right. Any more questions? Feel free to throw them at us. I think we've gotten through everyone's. I'm going to be testing my own Rocket Dollar IRA. I got my money a little held up on, it's not Bribe's fault, it's on my fault. Getting it into my own Rocket Dollar IRA, but as soon as that's in, I'm going to throw some money. All right, Mike with a great question. Who specifically manages the actual properties on the platform?
Yeah, we work with tech-enabled regional and national property managers to manage the actual tenants and the vacancy cycles and the leasing. Arrived also provides additional asset management functions such as rent optimization, the capital improvements, and holding the property managers to the service level agreements that we've signed with them. With those property managers, we also get better institutional pricing than a retail kind of mom and pop bringing a home into the property management sphere, because we can bring volume to them, and we generally get a little bit more attention and service being an institutional partner. So that's the benefit of investing with Arrived, is that you do get access to that institutional level of property management partnership, and you have an additional oversight layer that helps orchestrate all the components and make sure that it's efficiently being run.
Okay. All right. Thank you, Michael. Thank you, Cameron. Joel asked, will you be putting together a fund that will invest across all properties in the platform that are available, rather than investors having to invest in individual properties?
Yeah, and we hear this question a lot. I think today, the unique thing of Arrive with having individual property LLCs is, our view is that we'd like to create collections and kind of indexes in lots of different ways, where a collection of homes could form a pseudo fund, if you will, where you could say, I want to invest in this area of the country or this type of property, or maybe homes with solar panels or in college towns. And under, below the scenes from a product perspective, we'd be diversifying you across houses that match that bundle. But it may not be a fixed fund. So that's one option that we're exploring right now. The other is, yes, it's likely that long term we will have funds and more automated investing, just to be able to make it easier to set an amount on a recurring basis that you could invest over time as well.
Great, thanks. Yeah, and so Joe, always feel free, like you can make your own fund right now just by picking, like, I want to buy these 5, 6, and then the next, I keep want to target these, but they are thinking about that, because it's always a quick, you created your product like this way, but what about this? All right, thank you, Joel. How are maintenance issues handled, and how are costs assigned in the overall structure?
Maintenance issues are handled by the property management company, and the property managers that we work with have a very tech-enabled platform to communicate those issues. We review most of all of those maintenance requests just to make sure that our property manager is handling it in the correct way. So if it is something minor, like my dishwasher's not turning on, okay, you can go handle that. But if it's something more material that would require a CapEx expenditure, say replacement of a certain portion of flooring, we review all of those to make sure that the capital decision is the best one going forward. And as far as costs assigned, it depends on the nature of the issue. So there are some things that are just natural wear and tear. The functional life may have ended for a certain asset, in which case it is the owner responsibility. Other cases, based on the diagnosis of the issue, like let's say there's a hole in the wall, there would probably be no reason for the owner to cover a hole in the wall, and that would be a tenant chargeback that the property manager would assign back. So you would not be liable for that expense. It would be part of the payment back.
Okay. All right. Thank you for keeping the questions coming, everyone. Micah asked, is there any easy way to see expected dividend yields per property on the property snapshot page?
And for properties that are in markets where we've already paid a dividend, then we're showing the historical dividends that we've been paying in that market. We're working on better ways for new markets to make that available, but we don't have that yet. And so it's really just for markets. Once we've started paying a dividend, we can display that. Part of it is the public offering structure with the SEC, and we can't make forward-looking statements. So of course we have our own property underwriting, but we're trying to figure out, within the regulatory environment, how do we make that work? And that's where the historical dividends per market have worked for us there. But as far as for new markets, we're still working through that.
Okay. And then Jeff asked, 5 to 7% was mentioned earlier in the shareholder distributions. Is that estimate based on annually or quarterly? That's
an annualized estimate from the dividend side. And then the other portion is, the property value appreciation. And kind of those two combined things is what was building up to the 11.7% average that we had looked at for single family rentals historically.
Yeah, and just so Rocket Dollar customers, this is always an adjustment period of stocks and bonds. People see so many statements and live market data. I literally have a little thing ticking stocks up here now. Real estate is often, doesn't have that data. So, you're getting your quarterly distributions, and then, that kind of paper value that's arrives trying to help you see, when you hopefully, as the property is going to sell in a few years, or 5 or 7 or 8, whatever it may be, that really exciting gain over time. All right. Thank you, Jeff. Yes, cool questions today. All right. Thank you so much, Ryan and Cameron, for coming out today. We always get a lot of questions. If this is going to be recorded, it is, and it will also be on YouTube in about 1 hour from now, along with that instruction video uploaded right after that. Thank you so much for coming. Any closing comments for all of our Rocket Dollar customers out there?
Yeah, thanks a ton for having us on, and everyone for tuning in. As we mentioned, we have some houses that are for sale now. You can visit us at arrivedhomes.com if you want to go through the website. And yeah, thanks again for jumping on with us and spending time with Cameron and I.
All right. Thank you, everyone.